folks. Welcome to Pro Trader Strategies. It is Tuesday the 24th. I'm Eric Wilkinson, and we are an educational company. So what we're going to do is try and give you a little bit of an edge with that education. So before you go, hit that subscribe button, and next to it, there's a little bell because sometimes I come on unannounced. Yes, this is an announced or a pre-planned event here at 11:30 Eastern, and we do videos on Thursday, webinars after the close where we drill down on different option components. But if I find an option strategy or something to do later on in the day, I'm going to pop on here, and that way, if you have that notification or the little bell, it's going to give you a heads up when we're going live. Please smash the like button as it does help us out. And throughout this video, feel free to comment over there in the section below there, as I'm going to try and keep an eye on that, make sure everybody's clear of concept. If you have something you want me to look at, we'll throw it in here and dig into it, all right? So without further ado, let's get on with the economic data. All right, across the pond, not really a whole lot to talk about there. We did get the German GDP numbers. They came in line with expectations at 1.6%. Now moving back over here to the United States, we got our own economic data. Now remember, we were getting some housing data earlier on where we got the existing home sales a little bit better than expected, while we were seeing the National Association of Home Builders Index come off a little bit, which is a pretty good gauge as to the sentiment of what's going on in the housing market. Now that came off, but we saw the existing home sales do pretty good. And now we're seeing the new home sales, 708,000 expected to be 698,000. So higher than expected by about 20,000 there, about 10,000 there. So the homes are still moving despite the fact that we saw sticker shock from the consumer and higher prices. Lower interest rates, though. That's one thing we're seeing, was a little bit of a lower interest rate during that time. The real thing I want to key in on here, folks, is the Richmond Manufacturing Index. That came in at 9, expected to be 25. So these manufacturing indexes, despite the fact that the United States is a service sector, is really what's driving our economy or driving the economic movement here. We're going to need to see some manufacturing ramp up here, especially with all the supply chain issues that we've been seeing going on. I think that they're going to see that happen here in the United States, but it's not showing up in the economic data points here yet. So with that said, let's look at the overall markets and see what's going on here. We've got crude oil making that move higher. Now, the demand for crude oil is lacking. We've already saw gasoline move higher, while the distillates in the last inventory number were drawn down. Now we're seeing these manufacturing data points come in a little bit weaker, folks. That should kind of lessen that demand for crude oil, because when they break down crude oil, it goes into gasoline, jet fuel, and they call this distillates. That's what makes the polypropylene or the PVC. All right, so the plastics comes out of some of those distillates there. Now, that is usually a major driver of demand of crude oil going into the manufacturing sector. I think we're seeing that manufacturing sector weaken a little bit, and we're still seeing this drive higher in crude oil. Yeah, we've seen the dollar weaken a little bit, so that should give a little bit of buoyancy to some of these dollar-denominated assets like crude oil and gold, and we are seeing a little bit of follow-through there. I think crude oil is way outpacing what we would see in a weakening dollar, folks. I mean, it's only weakened by about a penny there, so driving the crude oil that much higher is a little bit bizarre on that, especially with lack of demand there. It's just really the institutionals pushing that market around. Now, Bitcoin, we talked about this yesterday, folks, is a break below that 50 handle was going to be pretty weak. The bulls needed to get above that psychological level of 50 and get a 50 handle settle, and they didn't get there. Came up shy of that. Now today, I mean, this is what we would typically call for a swing trade. You get the topping pattern, a hammer doji at the top of a move. You heard me say it time and time again. It doesn't matter if it's green or if it's red. I don't have my green ones filled in because it just gets a little bit fuzzy if I don't. So the green topping pattern, a settlement like this today is confirmation that we are going to revisit 43,788. All right, that is where we have that Fibonacci, the 61 fib. It has held support the last couple of times, so we're going to keep an eye on that. It will look to retest that. Something to note though, if it comes down and maybe bounces off this value area high, if it holds, let's call it 4,600 or 45.5, that is where we got the value area. That could act as a little bit of a support there, a minor support, if you will. And if that is, then we would say that it has a higher high, higher low, still trajectory is bullish. Break down to that 61 fib, that's going to start looking like that pattern's broken, folks. All right, bonds are coming off a little bit today, but it's because people are flying to the equities. We can see VIX is even moving a little higher despite the fact that we are positive in the equities. Again, though, making another topping pattern, just not a whole lot of follow through. I wouldn't really place any bets on a candlestick setup like this after this big move. I think we'd need a little bit more of a wick at the top there to make that look a little bit more bearish. But here we have the E-mini S&P the Dow Jones Industrial Average breaking out away from the point of control. Now we've talked about point of control acting as a magnet. Now, if we don't break that new high there, that is going to make it look like a bearish break on this newer highs type of pattern. So that would be very bearish for the Dow Jones Industrial Average. E-mini S&P is also making all-time highs, but that was done overnight. We've had fresh prints of high watermarks in the E-mini S&Ps, but this is printed overnight, and that's going to be something a little bit suspect that the day session will at some point want to revisit. All right, let's get on with a couple of trades that I've been working on. If you guys have been following along, playing with this game, you guys know where we are with these, but I'm just going to give a little bit of a refresher here for some folks that may or not have been privy to some of these trades, because they've been on for a few months now. And we haven't been always doing the live videos for these trades. So I want to make sure everybody's got those trades down. But I'm trying to find my little cursor here so I can switch it over to a marker here. See if that did it. Where are you? Popping up. Oh, it's over on the wrong screen. There it is. I usually have it popping up over here. All right, so let's go through this trade real quick and talk about the mechanics of this entire trade. So if you guys remember, back in the early throes of August, we're going to say August 5th, which is going to be right here on this bounce. So we got the confirmation of a bounce there. And then I've got a continuation pattern here. At least that's what I'm looking at. Whenever you get these counter-opposing dojis like this, that usually is a continuation pattern. But then I started getting these topping patterns here, and the market started falling off. Now, I was expecting us to have these bulls really break out here, because this was the travel and leisure section that I've been touting, especially in Vegas, where these folks are streamlining processes. We're seeing actually their revenue, or their revenues flatline, if not go down, but the overall profit margins are going through the roof here. Like their overall net profits on these casinos are better, even the actual profit number, not even percentages, the number is better than what they were seeing even pre-pandemic. So the pandemic has really gotten these guys to streamline process, get out some of the fat there in their companies, and are much more profitable now. Now, I said, even though they're only at 50% capacity, if they're making all-time profits, then why the heck wouldn't you want to buy these at a level that was pre-pandemic, folks? So, with that said, on the 8th or the 5th of August, which lined up right around here, I jumped on this trade and went into the September and sold the 35 puts. Why? Because I had high volatility. You can see the volatility is pretty high here. I expected volatility to come out on that trade. So then on the 9th, again, we got another opportunity here. So I thought this was the continuation pattern, right, where we were going to start moving to the upside. So on the 5th here, with high volatility, I'm thinking premiums are really expensive, so I need to take advantage of that. If premiums are expensive, do we want to buy something when it's really expensive? No. We want to lean towards selling. And I talk about how to do the calculation to figure out if premiums are expensive or cheap in my webinars. I'm just not going to have enough time to go over that right now. And then, so here I did the September. I sold the September 35 puts, cash secured puts. My thinking here is we are at these lows. I just kind of went through all of that. If we're at that level that we were pre-pandemic, and we're in a pandemic, these guys have streamlined their profits, and their profits are actually better than they were pre-pandemic, then that is something to write home about. I'll get long at that level. So I ended up getting a credit. God, collection of credit was something I was stumbling on there. So I collected 68 cents on this. Well, you can see volatility actually started coming up a little bit. And on this day, I'm still getting that continuation. Market slightly in my face. So I sold some more 68 puts, but this time I was able to collect 90 cents for it. So I've doubled up my position here in Las Vegas Sands on this. So a little bit heavier of a position or allocation towards one specific stock. I'm closer to better than 10% on this, which I don't usually like to do, but I was pretty solid on this. I would be happy to get very long Las Vegas Sands at 35 in my eyes. So what we can see here is now we've gotten this. Finally, everybody is jumping on board with the travel and leisure. Delta variant, not such a big deal. The Vegas guys are doing very well. But during that time, we can see that volatility really started coming out. So today, if we're talking about Vega, right, this is the coefficient that is Vega. And as Vega is coming out and the directional moves here to the upside, that is actually helping me out, right? So selling puts is bullish, right? So I'm selling puts, collecting a credit, cash secured puts. It goes down there, I buy them. I'm happy to get long at 35. I still get to keep all of that credit, $1.58. So my break even is really, $1.58 minus the 35 strike. So at 33.42 is my break even on this trade, right? Because I get to keep that collection. And Vega is like a 0.06, I think, on this. So we can see the volatility coming out in Las Vegas Sands by, let's call it, 2 percentage points. That's helped me out on this trade, and the directional move, the delta, obviously helping me out with that directional move to the upside. But what I want to talk about here is this volatility, getting involved in this trade with volatility relatively high. When it starts coming out, that really helps the back end of this trade there. So Las Vegas Sands, I'm not out of right now. My average dollar cost average on this is basically 158-ish. So I'm looking to get out at around 50 cents or so. Not quite there yet. I think it was trading just slightly higher than $1 last I checked. Now, Citi playing this trade. If you guys remember, this one's been going on for a while here. So we started out with this trade, lose my notes, on the 17th. And it started breaking down. I thought it was going to stay within this area. We got the breakdown below it and a rebound. So with this said, Citi Corp, I did the October. Whoops. Let me try and go back to this real quick. We used to say it was the Augie Ock on the floor, and it's actually, you don't want to slide for me now, do you? Let's see if I can do this. Just get the chart to go back to normal. There we go. All right, so basically on the 17th here, we did the calendar. I talked about this in the video. We implemented this strategy around all of the levers and pulleys we saw going on during that time of the video. So on the 16th, right around in here, I did the Augie or Augie, because the Augie is actually what is the thing that defines this strategy, because with the October, I'm doing the 63.5 calls, right? So 63.5 calls in there. We're getting long, selling the August 63.5 calls. Sorry, 62.5 calls. Can't read my own writing. 62.5 calls, sorry. 62.5 calls. Now, on this, I did it as a package, but essentially 194 for those, and I think 74 for these is where they matched up my pricing on these. I was able to cover these for 6 cents. So covered them for 6 cents on that. Now my break even is lowered by 68 cents on this trade, right? Because I covered it for like 6 cents or something, but lowering the overall cost basis on the ones that I bought on here. So now I've covered those, lowered the overall cost basis on this trade by 68 cents. So we're talking, I'm going to have to do the math in my head. What is that? 26, 126 is my overall what I paid out on this. So if I went to find my break even on this, I have to say what my debit is, right? My debit plus the 62 and a half calls, my break even on this trade is 126 plus the 62. So we're talking 6,376. So that is my break even on Citi. Now you can see we're above that trade right now at this point in time. So I'm going to let this one start to ride out. We're just making a move to the upside here today. People finally starting to get a look at that. Another thing though, with this pop today, this was offsetting my trade, right? As the volatility is coming out here, we got volatility coming out, but probably, I think last I checked, it was 2 percentage points of volatility. 2 percentage points in volatility going down on a Vega here, which was right around 06 as well. So 2 percentage points, that means 13 cents came out of my trade. Well, the directional move I got today was up about, let's call it $1. That delta, so I lost 13 cents here on the Vega because it moved down. I lost 13 cents, but I gained about 12 cents on the move higher from Delta, all right? So Delta gives us the rate of change to our premiums. Well, my premiums increased due to the directional move here, but I just want to talk about the levers and pulleys here. This trade, it looks exactly the same as yesterday because the volatility has completely offset that directional move today. Now, I'm not angry. I'm not hating on it. I knew that the market would move a little bit higher. We might lose a little bit of volatility here. So I'm looking for this directional move to happen in order to see this trade really start to work out. But something to note with the levers and pulleys, this is why I am so adamant about making sure we are good stewards of our capital, folks, is because when something like this happens, we need to know why this is happening and why I'm looking at my portfolio and Citi isn't making money today. Well, the fact of the matter is the directional move is being offset by that volatility coming out. I can't really do anything about it right now, but what I can do is set myself up for success when implementing this strategy, and that means selling premiums when they're super expensive and buying premiums when they're super cheap there, right? All right, so along the lines with the travel and leisure, Wynn is another trade that I'm playing around with on this. I haven't gotten quite close to closing this trade, but something to note, taking advantage of volatility. If you guys remember, this has been an absolute book about how to not trade a long position because I got into this and there were so many opportunities on a bullish move. I married this position, folks, and that's something we should do in trading. I kind of married my thesis on that with seeing Caesars do so well and all of these companies all of these casinos talking about streamlining the process, increasing profit margins, and all of those things. I got really wrapped up into this, thinking the market was going to make that move. So with that all said, if you guys remember in the Wynn trade, I had bought the September 135 puts in there for $8, and September bought the 135 puts for $8.35. All right, so my break even is way up here, almost near this high. Well, we started getting the market to come out. With the market coming out, I did get a little bit of volatility expansion, not quite as much as what I was hoping for, but we can see that volatility was expanding during the sell-off that I was long my calls. Obviously, the long calls were not working out. So I talked about this just recently. I went in and on the 5th of this month, so right in here, I decided it's time to get jiggy with it and sold some SAP because I got that volatility expansion. I sold the SAP 95 puts in there for $4.75. Now, with this said, now what I've created here is kind of a wanky position. If you will, actually, these are calls. I'm sorry, I wrote puts on there. These are the long calls, short puts. That is usually a risk reversal that I've kind of legged into here. But ultimately, what I'm looking at here with this trade, the way I've done this, is to try and stay mechanical by lowering my overall cost basis on a trade that's not working, okay? I'm not going to get clipped on both of these at the same time, so I really don't have to worry about it. What I'm worried about right now is trying to stay mechanical with this trade, lower my overall cost basis on the calls that I own by selling some of these puts. Now, if it goes down there, it's just, again, like the cash secured puts. I am looking to buy Wynn at levels pre-pandemic, all right? And we've already talked about during the pandemic, they're still seeing occupancy at the hotels, but the profit margin on the gambling aspect is going through the roof. So I'm very confident in the travel and leisure casino sector, if you will. So playing this to the upside is working out quite nicely today. And I'm getting some volatility expansion, though, in this trade. So that's going to probably affect my puts a little bit more today than the calls, because those calls are so far out of the money that they just, unless this market gets up to 140 overnight, I'm probably going to see those calls expire worthless. And I think that's it. I want to talk about City, Wynn, Las Vegas Sands. I also have Delta up here. All of this travel and leisure looks exactly the same. Let's flip through them. Look at Delta. Look at UAL. Look at, I haven't looked at American Airlines, but it's probably very similar. Wynn. I mean, all of these charts look almost like you wouldn't even know that I'm switching this one. Caesars is probably going to be as well. All right, so I hadn't even checked on Caesar and American Airlines. All of those charts look very similar, moving back towards those points of control. So bullish sentiment across the board in that, for my eyes, and an opportunity to play something bullish there. All right. That's it. Before you go, folks, make sure you hit that subscribe button. There's a little bell over there to the side. Click on that. Make sure that you got notifications of when we're popping on here. Smash the like button before you go. That helps me out. It really does. So appreciate that. Appreciate you folks. And comment if you have any questions. I want to make sure you folks are clear of concept before I go. I will circle back around for you and make sure everybody has their questions answered if you're throwing them out there. All right. So yeah, take that. Take it easy. Bye for now.